A lot of people talk about Brookfield Corporation stock, but how many of them can tell you what it is they do? Don't ever invest in a company unless you understand what they do. Today we're going to try and understand Brookfield Corporation stock and talk about why we'd never consider investing in the company. Now, there are a lot of Brookfield entities out there, so things are going to start getting confusing really quick. Let's start at the top. What does Brookfield Corporation do? In its simplest form, they're a holding group comprised of numerous other businesses. Their mandate is to buy assets that the market has discounted and sell them at a premium down the road, the old buy low, sell high. They invest across a variety of asset classes, so we want to understand what those are so we can understand what exposures we're getting from this stock. And we're going to want to identify a key net asset value metric to monitor. That helps us understand what the price of the stock is trading at versus what the intrinsic value of the asset is. That's very important, as you're going to find out soon enough. So the basics, they describe themselves as having three core businesses. So you have alternative asset management. We're going to talk about alternative assets later. They have wealth solutions, and then operating businesses, which fall under a number of categories, including renewable power infrastructure, business and industrial services, and real estate. They say we have a track record of delivering 15% plus annualized returns to shareholders for over 30 years. Now, that's great, but this is by far one of the most complex entities I've ever seen. And I've seen a lot of complex stuff out there. It's not a good thing when an asset is this complicated. And let me give you an introduction to the complexity on offer from Brookfield Corporation. So we start at the top here with Brookfield Corporation stock trading under the ticker BN. And then you can read this chart for yourselves. It shows various other publicly traded entities, at least 5 that I count here on the screen. This was taken from Seeking Alpha. I think it does a good enough job of showing how complicated things are here. And in this piece, the author says that they believe this surface level complexity is partially responsible for Brookfield Corporation's substantial undervaluation. They're implying the market doesn't understand the value on offer here. And we're going to argue that indeed the market understands it very well. It's something called the conglomerate discount. And we're going to talk about that. Now, it's very important to distinguish between the price of an asset and the value of an asset. And this was taken from a shareholder letter. This is the CEO of the company saying price is a function of supply and demand at any point in time. He talks about how that's influenced by news of the day, short-term results, social media, an investor's view of macro events. But then this statement here I love. He says value, on the other hand, is the net present value of future cash flows based on assumptions for growth, discounted back to the present at an appropriate interest rate. That's perfectly put. He says here the price of a publicly traded security is very often not the value of it, as we see in the case of quantum computing hype, for example. Sometimes it is higher, and that's a good example, and sometimes lower. Lower is often difficult to distinguish between value and value traps, as we've talked about before. This statement is very important. From time to time, they can converge, but not that often. And we're going to talk about that. So here's the value on offer that you'll see talked about for Brookfield Corporation. The company talks about it here. They say the price that this company trades at, so let's say the market price, it's about $55 a share right now. Compared to the value, remember we talked about intrinsic value, the company has calculated that at $84 per share. So you're purchasing $84 a share for $55 a share, and everybody will say, well, there's value to be had. Not necessarily, and that's because a good example would be where you find stocks, usually small caps or micro caps out there, that are trading for less than the cash on their books. In other words, you're getting a free business along with the cash that you're getting at a discount as well. There's a reason for that, and the market is very good at valuing assets, and it's not very easy to distinguish bargains to be had, as everybody is implying with this stock. So when they talk about plan value, so that's the metric that they suggest that you watch as opposed to the price of the shares. And here they calculate that out, and you can see those 3 categories. This is great. We see asset management is dominant. We're going to take a closer look at that piece. Wealth solutions and operating businesses, and there's quite a bit underneath that umbrella. Then they subtract debt and preferred capital, and they have total planned value, and then they calculate that out per share. So that's the $84 number. So everybody will say, well, Brookfield is undervalued. Not necessarily. Big question to ask here, does it always trade below planned value? In that case, it's a form of the conglomerate discount. And we asked an LLM, and here's what it said. Brookfield stock rarely trades at its planned value per share, often trading at a significant discount, they say, a gap of around 40% between the market price and the planned value. Now, we didn't go back and check that over the years, but it seems like a reasonable assumption. Now, a question that I've often asked myself, is the conglomerate discount good? Another example of this would be stocks that trade on foreign exchanges at a discount for what they might be trading at in the States. Now, that can be explained away by things like liquidity and such, but stocks or assets that always trade as a discount, is that good or bad? Well, perhaps it's preferable because then you can have spin-outs that often unlock value. You'll see conglomerates often do that. They'll spin out a part of their business and in hopes of unlocking value, getting rid of the conglomerate discount. And one may ask, is that why Brookfield chooses to have so many publicly traded entities? I don't know, but let's step back for a second and ask a simple question. What exposure are we trying to get with an investment in Brookfield Corporation stock? Now, I'll answer that from our perspective. When we look at Brookfield Reinsurance, we already have insurance options available in our DGI strategy, and by that I mean stocks, not options. Brookfield Renewable Partners, well, we've opted to hold the largest renewable energy company in the world, and I don't think we want exposure beyond that, something we've talked about recently in our piece on the state of the solar industry. Brookfield Infrastructure, well, I'd argue there's plenty of great industrial companies out there, and a handful that we're holding, and these are probably highly correlated to infrastructure. And then alternative asset management, that's what we're most interested in, and I wanted to talk a little bit more about that. So when we look at alternative asset managers, here's a list of the top by assets under management, what they call AUM. You see Blackstone at the top, followed by Brookfield, and then Hamilton Lane. So Brookfield's one of the largest asset managers, and for some reason they seem to be quite popular now. I don't know why that is. We're covering Brookfield Corporation because it's been raised so many times by our paying subscribers. Since they pay the bills, they get to dictate what we cover in many cases. Now, you need to be careful here. Are you talking about Brookfield Corporation or Brookfield Asset Management when you bring up Brookfield? Well, Brookfield Corporation, but now we're talking about Brookfield Asset Management. So let's make that distinction. That's what you see here in the table. So first, let's talk a little bit about alternative assets. Now, I took this chart here from Candor, and I really like how they've depicted everything here. These are types of asset classes. The more traditional ones you'd be familiar with are, of course, cash equities, stocks, right? Or fixed income. And they've further elaborate. So on the bottom here, you can see the definitions, which I quite like, but above each asset class that we've highlighted, the band of asset classes there, you have different types. So I think when you talk about ownership of a business, funding startups would be considered an alternative asset class. It's a lot different from a publicly traded stock. It behaves differently. It's not necessarily correlated. It provides a diversification effect. So various asset classes are often not correlated or negatively correlated to equity. Since most investors out there hold heavy on the equity side, it's important to have some diversification effects. This helps you sleep well at night. Alternative asset classes do not fall into one of the conventional investment categories such as stocks, bonds, or cash. But as I talked about before, there's always some nuance there, right, in definitions. The distinguishing feature of alternative asset classes in general is they're not very accessible to your average Joe retail investor. Now, when we think about alternative asset managers, I think there's three paths to choosing how one might go about investing in these entities. The easy one is to choose the name being wanked over the most on social media, which is I think a lot of folks do. The better way might be to buy a basket of names, perhaps some of the biggest names, and then you're avoiding idiosyncratic risk, which is where if an alternative asset manager should pull an Enron, then that's a big problem, right? The harder method would be to cherry pick a potential winner. So to do that, you'd want to have a predefined method. You'd want to apply it across all top names, at least the publicly traded ones. For example, you might choose your favorite alternative asset manager based on the exposure you're getting or their strategies, and that's something that you'd have to dig into. So we're going to assume you took the hard path and you picked Brookfield Asset Management for some good reason. Now, when you go to further investigate this stock, you're going to want to be careful because Brookfield doesn't do a very good job here on branding, and it's easy to become confused between Brookfield Corporation and Brookfield Asset Management. That's the one that we're looking at now. So make sure you've pulled up the correct website. All the collateral appears exactly the same, so make sure you're looking at the right collateral. And for example, you can pull up the latest press release with their third quarter results. There's a couple terms that stand out right away: fee-related earnings and fee-bearing capital. So the idea of being their capital that they're managing, they collect a fee on that, and that would represent earnings. And here you see they talk about key strategic sectors: energy transition, so green energy; AI infrastructure. I'll bet you're going to see across multiple alternative asset managers them jumping on the latest theme; and private credit. Now, we want to understand what exposure to each of those we're getting. So when we scroll down in that press release, we don't get anything. It simply says investments. Here you can see those spelled out as a percentage of their total assets. Now, what you can do is click on another piece of the many bits of collateral you'll find in the website that's structured exactly the same as Brookfield Corporation is. And now we're getting somewhere. Here's Brookfield Asset Management overview. We see assets under management of $1 trillion. That's correct, right? We saw that on the table before. Fee-bearing capital, so that's something that you want to pay attention to. In the same way for any asset manager, funds flowing in, inflows; funds flowing out, outflows. And then you can see on the right there are businesses by fee-bearing capital. And here you can see everything broken down: renewable power and transition, infrastructure, private equity, real estate, and of course credit being the lion's share of the assets they have under management. Then you can see fee revenues broken out. So the idea here would be, are each of these businesses as profitable when it comes to earnings as the others? And actually the ratios break out quite well. So this is a basket of alternatives that exposes us to company-specific risk. So going back to those three paths, buying a small basket of leading alternative managers doesn't sound like half bad of an idea. Now, it may be correlated to the broader stock market, the price that is, not necessarily the value. We would prefer more targeted exposure to specific themes. So without looking at historical performance, you might ask yourself, why is Brookfield better? Now, don't say Bruce Flatt unless you've worked with Bruce Flatt. He certainly has a lot of intelligent things to say, but that isn't a good enough reason. All these leaders of all these alternative asset management firms are highly competent. Everyone has a plan, and you can look at the 179-page investor relations deck they have with all these great plans. Everyone has a plan until they get punched in the face. So asset classes we find particularly interesting would be things like hedge fund strategies from proven managers. Of course, that's very difficult to get your hands on. Early stage startup exposure, that's something we've been looking at in past pieces. I think that's hard to get your hands on for your average Joe retail investor. And then something perhaps easier, broader commodities. Now, our own alternative assets include art, wine, Bitcoin, and gold. And I think in this alternative asset mini-series, we're going to be examining other avenues. So make sure that you're subscribed for these coming videos. Now, I see this piece here by the Fool. Billionaire Bill Ackman recently bought one of my favorite stocks. Here's why I think it was a brilliant move. Of course, it's a brilliant move. He did what you did. These complex entities attract pundits, I think, who can then weave stories that others can't easily challenge. You see this article by the Fool. The Canadian investment manager's operation might seem a bit complex at first glance. It's extremely complex, made at every glance. It's probably the most complicated thing I've ever looked at in the many years that I've been in academics and in industry. This is a great stock to recommend if you like to sound smart. You can just cherry pick talking points from the 171-page IR deck. But experienced investors, they recognize this for the complex animal that it is. Now, people will say, well, Bill Ackman is loading up. It must be good. Well, you're not Bill Ackman, and you should know better than try and ape active managers. You don't know what sort of deal Bill Ackman has arranged with them. You don't know anything about Bill Ackman's decision to invest in that company. People will say, well, it's a cross between Berkshire Hathaway and Blackstone. Well, then just go buy Berkshire and Blackstone. It's likely going to be a whole lot simpler. Now, a little pop quiz. Why isn't Berkshire Hathaway an alternative investment manager? Well, it's because Buffett largely invests in public companies and private ones that he buys outright. It's very easy to look at the asset statement for Berkshire and to see those there. And it's a lot easier to follow than the Brookfield Corporation mess of a company. Now, we don't hold Berkshire because the strategy overlaps with our Quantigen's dividend growth strategy, but this really goes back to what exposure you're looking for here. Now, rules we live by. We never invest before revenues in positive gross margins. That single rule has saved us from more landmines than any other. Simple is best. We always talk about the 3-fund portfolio being the most predictable path to wealth. It's certainly the easiest. There is no free lunch. People always want to try to find some diamond in the rough, some free lunch. There isn't any free lunch. And don't use leverage, whatever you do. And the vast majority of retail investors should stay far away from options. We lead by example in that respect. And we do not invest in extremely complex businesses, no matter what rewards are said to be on offer. So I'm going to go ahead and leave you with a piece here we did on investing in startups. You can invest with as little as $500. It's rather an interesting value proposition. Thanks so much for taking the time to watch this today.